We talked in the last video about different cost classification vocabulary, whether things were direct or indirect or product or period or selling and administrative or overhead, all of those different costs. Now we're going to talk about behavior. So cost behavior is how a cost reacts and changes the level of activity. We have three main classifications for behavior: variable cost, fixed cost, and mixed cost. We can have direct and indirect costs and product and selling and administrative costs that fall within each of these categories. So often costs have multiple classifications, as you've already seen through various things. So for example, a direct material is a product cost. It's also a direct cost. It's also a prime cost, and it's usually a variable cost. So we'll look at each one of these costs. So variable cost is a cost that changes in proportion to the changes in activity. So, and its cost per unit is constant. So let's think about a variable cost that is a direct material. So say we're manufacturing a car. We'll go back to a car. And we have a steering wheel. We only need one steering wheel per car. So there's a cost that varies in total in proportion to changes in the level of activity. If we make one car, we need one steering wheel. If we make two cars, we need two steering wheels. It has a per unit constant. So a steering wheel will say cost $25. Every steering wheel costs $25. If I use one steering wheel, it's $25. If I use two, it's $50, but it was still $25 per steering wheel. When we talk about an activity base or a cost driver, this is what causes our variable cost to happen. So, for example, the number of units produced. If I make one unit, it costs this much. If I make 10 units, it's 10 times the amount. Okay? Same thing with direct labor hours. If I work 1 hour, it costs this much. If I work 10 hours, it's 10 times the amount. So this is what is called a cost driver because it is what drives the cost. A fixed cost is a cost that remains constant regardless of changes in the level of the activity. So examples of a fixed cost are things like rent. We have to pay the same rent every month, regardless on our factory, regardless of how many items we produce. If we produce one item or 5,000 items, our monthly rent is exactly the same. So rent is a fixed cost. It remains constant. If we look at a fixed cost on a per unit basis, that's different. It's going to change. So say if my rent is $5,000 a month and I only produce one unit, then my cost of rent per unit is $5,000. If my rent is $5,000 a month and I make 5,000 units, then my cost of rent per unit is $1. Fixed costs are often committed long-term costs that we cannot reduce in the short term. These are things like rent, salaries, items that we've signed contracts for, and we can't get out of the contract for a period of time. Discretionary fixed costs can sometimes be altered in the short term by manager decisions. Examples of discretionary fixed costs might be that I could rent an extra warehouse for a short time and in order to meet a seasonal event, or I might be able to add on a second shift for 3 months to help with a production backlog. All costs are linear. So all costs are linear. Accountants look at straight line costs or constant costs. So there might be a curvilinear variable cost line that gets more into some mixed costs. We're mostly going to be looking at straight line costs within our accounting information. When we look at the relevant range, we look at relevant range for fixed costs. So our relevant range is the amount of activity where fixed costs remain the same. Okay? So for example, if we have office space that's $30,000 a year for 1,000 square feet, then our relevant range exists within that 1,000 square feet. If we needed another 1,000 square feet, we would have to add another $30,000. So that relevant range is how much can we produce or what services can we provide within our current fixed cost structure. And any addition beyond that top range would require us to add additional fixed costs. So here we have every time we rent an additional 1,000 square feet, we add another $30,000. This is just a chart showing those things that we talked about when we were looking at the slides. So the variable cost, the total variable cost goes up in proportion to changes in activities, but the variable cost per unit remains constant. So if the steering wheel is $25 per unit, it's always $25 per unit. But if we make 2 units, then our total variable cost is $50. The fixed cost has the opposite effect. Our total fixed cost stays the same regardless of change in activity, but our fixed cost per unit decreases as our activity levels rise. So that's where I talked about if our rent is $5,000, if we make 1 unit, the fixed cost per unit is $5,000. If we make 5,000 units, the fixed cost per unit is $1. A mixed cost has both variable and fixed cost elements. This is most common with utility costs. Water and electricity are both mixed costs. You have a fixed monthly utility charge, and then you have an amount that is based on usage. In electricity, it's the amount per kilowatt. In water, it's the amount per gallon usage. With a mixed cost line, we use the equation of a line. So they show here where Y is the total cost, A is the fixed cost, B is the variable cost per unit, and X is the level of activity. So the equation of a line becomes the cost equation. If you've taken algebra or other math class, you've seen this equation expressed as Y equals mx plus b. So y equals mx, m in a line equation being the variable cost per unit of activity or the slope of the line, and then b or mx plus b, that's the total fixed cost, the vertical intercept of the line. I don't know why they used y equals a plus bx instead of just an equation of a line. It makes things confusing. But this is where we look at where the line intercepts and the total of the line. So in this example, if we have a fixed monthly charge of $40 and then pay an additional 3 cents per kilowatt, our cost is going to change based on the number of kilowatts that we use. So if we use 2,000 kilowatts, our charge would be $100. But if we used a different number of kilowatts, so let's say we used 1,500 kilowatts, we would then take 1,500 times 0.03 and then add $40. And then our monthly charge would be $85 instead of $100. The last cost classifications are cost classifications for decision making. So our decisions involve us choosing between different alternatives. We're going to be looking at this a lot more in chapter 13, where we have to choose between two different things. What we have is differential costs and revenues, opportunity costs, and sunk costs. So differential costs, also called incremental costs, are the difference between two alternatives. So it's just the difference between the two alternatives. So a lot of the time we get rid of all of the costs that are the same and we say that they're irrelevant to the decision making. So only the costs that are different are important to making the decision. So if we were looking at, say we were looking at taking a vacation and the airline ticket and the hotel and the cost for driving and gas was the same between both alternatives, we would say that those costs were not relevant to our decision because they're the same whether we choose A or B. What is different might be that the resort cost is different between destination A or destination B. So it's only the difference in the cost, incremental cost or revenues. Opportunity cost, if you remember from economics, opportunity cost is that potential benefit given up when you choose one thing over another. There are a lot of things that constitute opportunity costs that we'll look at. So of course they don't end up in our accounting records, but we still have to think about them when we're deciding any decision. So we have limited resources. We have limited factory space, limited money, limited hours in the day. And so we have to make decisions about what we do with that money, what we do with that factory space, how we do our production. What if we can make two products, but we can only make, because of the machines we have available to us and the number of hours we have in one day, we can only make so many of one versus the other. Then we need to decide what is the most advantageous to us financially. And we will be doing these calculations throughout the semester. We'll be making these decisions when we have a restricted number of hours. What should we be doing the most of in order to benefit our company financially? Then the last costs we look at are sunk costs. So sunk costs are costs that we can't change. We should ignore them when we're making future decisions. Even if they're significant or huge, we could have sunk costs in the millions of dollars. The fact is that regardless of what decision we make, we can't change them. An example of a sunk cost would be maybe we purchased a building and we've been using this building and now we're not so sure that it's really serving our needs and we need to buy another building. The cost of the first building is a sunk cost. We can't get it back. We already spent it. It might have been a significant amount of money, but it doesn't matter to our future decision making because we can't get that money back. So sunk cost is the last classification of costs that we cover in this chapter. And then different income statement formats. So we have our traditional income statement, which is used for external reporting. Sales minus cost of goods sold equals gross profit minus selling administrative expenses equals operating income. We're going to look a lot more at contribution format income statements. And then in other chapters, we're going to add a couple of different formats of income statement. But what a contribution format does is separates out variable expenses and fixed expenses. And this is used internally for decision making. The contribution margin of a product or a product line or a segment or division is used instead of their net operating income to make various decisions and performance evaluation judgments. So when we look at this contribution income statement format and use it for internal planning and decision making, we will use it multiple times throughout the semester. We're going to look at it in chapter 5, 6, 8, and 13. So that was chapter 1. As I said, it's a lot of vocabulary, it's a lot of information. In chapter 2, we start putting numbers to that vocabulary, and it helps. We'll start looking at some service and manufacturing organizations and how we use these cost classifications to determine how much product and services cost